Today I'm going to tell you how to purchase a property in your early 20s. It can be a really simple and inexpensive process if you do it right and you take the right steps. Everyone thinks that buying a property is going to be very expensive up front. That's what scares people away most of the time. And I'm here to tell you that it's not as expensive of an investment as you think. Now, of course, you'll have to pay your monthly mortgage and whatnot, but I mean, you pay rent anyways. So let's start off with your credit. You will need credit to do this. There's no way a bank's gonna give you hundreds of thousands of dollars without any credit. So if your credit's already established, you can skip past this part. I'll try and put some timestamps in this, but for those who are just starting off and need credit, the first thing I would do if I were you is get a secured credit card. Discover Bank has a really good secured credit card. You will make a security deposit of about $200-300 and you use the credit card like normal, and in about 6 months they'll give you your $200-300 back. Now you can put way more into the security deposit, but there's no point because it will just give you a higher credit limit. It's nothing really special about it. As far as any other credit cards, I don't know. Discover is the one that I went with and it worked very well. Now, after about 6 months, when you get your security deposit back, you should try and go for another credit card. Now, you could stick with Discover because you're already a trusted person, or you can find another another lender for the credit card. You want to start working on a second credit card. Now, the thing with credit cards is it's not free money. You should learn how to utilize a credit card properly before you try this method. Don't just go spending willy-nilly on it. You know, of course, you want to use it the right way, but you'll build on a second credit card. And then, you know, another 6 months, you kind of want to keep this in a rotation of every 6 months. Another 6 months go by, you should get a different form of credit, whether it's on a tool, on some furniture, something of that nature. Something of that nature. Now, what I did personally was I bought some Snap-on tools that, you know, were about, well, I did it in different increments. I bought some Snap-on tools for a $500 credit line, paid that off in 6 months, then let some time go by in between, then open another credit line of about $500-600 and paid that off, and those boosted my score very well. It's the same case if you use some furniture or some other kind of toolings, get something from Home Depot, something you may need, something you could use to invest in some kind of side hustle you have, whatever the case may be. But you don't really want to shoot too far over $1,000 on this credit line because there's no need to. People make you think, the common misconception with credit is that everyone thinks that you have to open huge lines of credit like a car or something big. No, you do not have to do that. You can stay under $1,000 and open a line of credit easily, and it'll still build you substantially. Now, after you go do those tool ones, you can start shopping for another credit card. Now, the credit card that I went for was the Amex Gold. It does have a little bit of a boost to building your score when you use this card, but you know the Amex is more so for the benefits. If that doesn't suit you, then I wouldn't say go get it, but I went for Amex Gold as like my new primary card because after you do all these steps with the 2 credit cards, 2 lines of a loan, 2 lines of credit, I'm sorry, now you get your real credit card, which you would use on a daily basis, whether that be a Chase Sapphire, Amex Gold, whatever credit card you want to use as like a daily, because when you're using it as a daily, you want to reap the most benefits. You want to find one that has good cash back, good bonus programs, good point programs, whatever. So I ran my Amex Gold for about, I got it in December 23, about a year and a half. Yeah, about a year and a half. I had my Amex Gold, just building up points, and doing these exact steps, nothing different, always paying off on time. I was able to reach about a 760, 765, something around there credit score when it came time to do my pre-approval. Now listen, I didn't say anything out the box. I just opened a couple credit cards, a couple credit lines that were about 500 bucks. Nothing thousands of dollars. No, you don't need to go finance a 2025 Honda Accord to build your credit. It's actually the worst way to do it, because it's a, you know, depreciating asset. You're losing a lot more money on that. Now, when you're doing a loan on 500 bucks, then it doesn't really, the interest you pay isn't as high as if you're paying interest on a $30,000 loan, of course. So also, I forgot to mention, throw in there, one thing I would do for the credit too, I'm sorry I left this part out. I've had maybe 5 cars in the span of this time, and cars need regular maintenance, right? Oil changes, tires, whatever. So I go to Discount Tire to get my tires. I open a credit card through them, and I've been buying all my tires for all my cars through that credit line or credit card through Discount Tire. You're paying like 80 bucks a month or whatever, you know. It seems tedious, it seems extra to have all these credit cards, but that's definitely a better option than opening a huge line of credit. Then you're slave to a $500 car payment or whatever, you know, all of the above. You want to also save as much money as you can, which is going to take us to our next topic. You obviously, I say it won't be as expensive as, you know, what you may think, but of course you still need a savings. Now, in this time span will be 2 to 3 years if you're starting from ground zero. So within this time while you're building your credit, you want to make sure that you can somehow save at least $1,000 a month, at least. Now, you may be listening and you may be living paycheck to paycheck, scraping by. Well, it may be time to find a side gig, a side hustle, some way for you to make an extra $1,000 a month. You should always try and shoot for an extra $500 to $1,000 a month on top of your base salary, even if that's working your regular job overtime to add that extra $1,000 to your base salary. That is how you stay on top of the game. You don't live paycheck to paycheck. Yes, you will have to work a little harder than just go to work 9 to 5 and come home. Yes, you're looking to buy a multi-$100,000 property, so you can't just sit around and be like the rest of your peers. You have to work a little harder than the rest. You know, that's just what comes with this. And like I said, 2 years, maybe even a year if you get really hard on it. Because if you make this extra $1,000 a month or whatever, you may see that 1,000 and it may make you want to shoot for 2,000, 3,000, whatever. But at the minimum, even if you can do about 800, that'll still be good. You want to have a nice savings coming in from some other area than your main job. And you just throw it all right in your savings. Whether that be DoorDash, you do oil changes on the side, you do whatever. You can figure out a million things. You make blankets for people and sell them, whatnot. You just want to make a side income from that. And say if you save that $1,000 a month for 2 to 3 years, that could be $24,000, $36,000. You know, this is good money, and you're gonna find out this is way more than what you need based off my experience. So you want to save those $1,000 a month. But like I said, there will be months where you save way more than that, because you already built this habit to save so much money. Because saving $1,000 a month is good, guys. This is not like a most people don't do this. So 1,000 is really good. A lot of people can't even save 500 bucks a month. So 1,000 is really good. Once you get in this habit of saving a lot of money, you're gonna want to save more and more. From personal experience, my first year of doing this, I was able to save about $30,000, $32,000 in the first year of doing this, and that is 12 months. So I mean, you can do the math on that. That's more than $1,000 a month, and that was that was because once I got in that habit of saving so much money, it made me want to save more and more and see how much I can do, challenge myself to see how much more I can save. So that's why I always say go for the base of 1,000, because you'll usually go over that. And over the years, you save up this money. To keep it short and simple, you save up this money. You have, let's just say you got 25 grand saved up over these 2 to 3 years, because you know life does happen. You will have to spend some of this cash. This is not, you won't be able to bank all your money forever. There will be things that happen. Your car may break down. You may need a new car, whatever. You can't bank all this cash. So say you got about 25,000 and now you want to shop and buy for a house. You have 25 grand and there's a first-time home buyers program for plenty and plenty and plenty of lenders. Now, the one I did was through my credit union, but you can do an online lender, whoever. But I would suggest doing a credit union, because that's just what I did from my experience, and they gave me the best options of all of the other lenders that I seeked. So you're looking at about 3% down. Now 3% down on a $200,000 house is right in the 5,000 to 7,000 range, depending on, you know, I'm not saying exactly 200,000, but depending on where you move the needle, you can go under, you can go a little bit above. That's about 5,000 to 7,000, and that's kind of the, you kind of want to be in, if say you have 25,000, this is your first home, you don't have 6 kids or whatever, you know, I'm assuming that you're in your early 20s, you don't have you don't have kids, you don't have a bunch of people who need to move with you, you may have a girlfriend or boyfriend, you know, you want to look for a house in the 2 to 220, maybe 250 if you're feeling splurgy range, because those are going to be your small ranch style homes that have 3 to 4 bedrooms, 1 to 2 bathrooms. You don't need a lot. You know what I mean? This is, if you're only one person, you don't need to buy a big $500,000 house. That's another misconception. When people hear buying a house, they always think of like this 4 or 5 bedroom, 3 bathroom, 2,000 square foot house in suburbia. That's not every house that you can buy. You can buy a normal ranch style home that is, you know, 1,000, 1,500 square feet, and it gets the job done. You do not need all the extra space, because you are just you. And if you need to leave it at some point, you can in like 5 years, you know, but it'll get the job done. If you randomly have a baby, you have enough bedrooms to put the baby in. It won't move you out the house. Okay, so 200 to 250,000. Of course, you can go under that, but let's just say this is a good range for a decent house. You will find your lender, and for a first-time home buyer, your down payment will be 3%. So let's say in my case, where my house was a little over 200,000, a smidge over 200,000, my down payment originally was 6,800 bucks. Now, let's say for you, you have your 25 grand. $6,800 bucks. That's a decent amount of money, but that's not eating away at your entire life savings, okay? And for most people, the closing cost on a house like that, you would be looking at about $5,000. Now let's just start there. $5,000 would be your highest closing cost. So you're looking at $11,800, and that's it. That's your entire upfront cost. But what I did is I have a federal credit union that I use as a primary bank, and I went with them as a lender instead of one of the online guys, and they pay about $2,000 to $3,000 worth of your closing costs. They'll pay $2,000 to $3,000 worth of your closing cost, and they'll give you the first time home buyers discount rate of 3% down. So let's say you work with a lender like that. Now you go from $11,800 to $9,800. Now you're under $10,000. Okay, so under $10,000, you have a $200,000 house. That is a lot for somebody in their early 20s. You have a yard, you may have a garage. Like in my case, I have a detached 3-car garage. You have ample amounts of space. You have neighbors, but they're not wall to wall with you. You don't have to go up 3 stories of an apartment. So this is a pretty good deal. And let's talk about the mortgage now, because that is important, of course. The monthly cost. Your monthly cost, say you go with a lender that has a private mortgage insurance, because a lot of them will have that. When you put 3% down, they make you pay insurance on your mortgage because it's such a low amount. And this insurance usually costs about $150 to $200. Well, with that being said, that on a $200,000 house, your mortgage will be around $1,600, which is pretty pricey, and it is a little higher than, you know, most of us will want to pay in our early 20s. We're kind of just starting off our career, and a lot of us don't have like a super high income. And even though we may make that extra $1,000 saved a month, it still is a little high. So with my personal lender that I had, my credit union, they offered a loan with no PMI. And this is what you really want to look for. No PMI, because maybe you would compromise a higher interest rate with no PMI, because no PMI, an extra $200 every mortgage, that can all be wiped away, and now you're looking at $1,400, which sounds a little bit better. That sounds closer to a luxury apartment, at least in my area. I can't, now if you're in California, of course these won't really apply. These are for more so like Midwest people. But $1,400, it's about what you pay for a luxury apartment. You get a yard, a garage, you know, nobody's on top of you, below you, beside you. You have plenty of space. You know, you can raise a family in there, a small family in there, and you're building equity in this property. So $9,800, you can be in a house of your own with all these amenities that I just listed. $9,800. Everyone makes you think that it'll be $50,000, whatever. $9,800. Let's just say $10,000 to make the math easier. You spend $10,000 of your $25,000. You still have $15,000 left. That's a nice savings account to go do whatever you want to do, whatever your heart pleases, whatever your heart desires. And you already have these good saving habits built into you. It's been years. These are habits. These are a part of your lifestyle. So you will continue to do this, and you will move on, and you know, now you can enjoy the fruits of your labor. You can do whatever you want with this extra cash. But those are just my simple steps to how to buy a house in your early 20s and any point in your life. I say early 20s because this is kind of how you would do it from scratch. If you just got out of high school or whatever, just got out of college, that's how you do it from scratch. But Anybody can do it this way. If you're a first-time home buyer, pretty much all of this stuff still applies. Now, if it's not your first home, if you own a property before, which wouldn't be majority of the demographic watching this video, but if you did own a property before, this first-time home buyers program does not apply to you. So, also, one thing I should throw in there is yes, this could be an investment property, but for the first-time home buyers program with any lender, you have to live in this house as your primary residence for at least a year. Because if you buy this house and put the 3% down and you don't make it your primary residence, you will lose the deal of this loan. So, and you will owe them a bunch of money, and you're voiding the contract, a bunch of stuff you don't want to deal with. Just don't do it. You don't even want to know what the issues would be. Just live in the house for at least a year if you're going to do it. So pretty much that's how you get into a house for under 10 grand in your early 20s and enjoy the fruits of your labor. So that's all I got for you guys. You can check out my other video on how to buy your dream car. It's very similar to this video. A lot of helpful information. Thank you. I'm out.